want to bring in our panel, Bull Tick Capital Markets Chief Strategist Kathryn Rooney Vera, Federated Hermes Chief Equity Market Strategist Phil Orlando, and Gibbs Wealth Management President Aaron Gibbs. All right, first, let me get an assessment from everyone on what we just heard about the Fed, the market's initial reaction. We're getting a little bit under some pressure here. And I guess the question is, are we mature enough as a stock market to handle the inevitable unwinding process? Kathryn, let me start with you.
What has taken us to these levels is the Federal Reserve buying $120 billion in assets per month, and the Fed's spending and deficit finance spending like we've never seen in the history of our country. If either of those two things fails us, Charles, we are in for a rough ride. So my answer to that is yes. I suspect that the Fed is not going to be tapering anytime soon. I doubt that he even mentions it at the presser this afternoon. A lot of, I would say, consensus is that he's going to give some hint towards tapering by the end of this year. My bet is that we're not even going to think about it until end 2022, and that depends, Charles, on where we are in the state of the economy. If, in fact, this V-shaped recovery that's been so favorably affected by base effects from a catastrophic 2020 continues, or, in fact, we see some sort of rollover.
You know, Phil, of course, Chairman Powell is famous for saying that he's not even thinking about changing course. But we did have some language changes just now, right? So the health crisis, we had a little bit of a tweak there, a little bit of tweak on the strength of the economy. Inflation is still transitory, but are these the sort of baby steps you were expecting?
We were expecting absolutely nothing on the policy side today, which is what we got. I think in terms of the Fed's thought process, they've got to really focus on this inflation question that the market is growing increasingly concerned about. Now, this coming Friday, we're going to get the March reading on core PCE, and that is expected to go from 1.4% year on year in February to 1.8% year on year in March. That's a pretty big jump in 1 month. And then over the course of the balance of this summer, we are going to be lopping off the low or the negative inflation readings for March, April, May, June a year ago, and we could see the core PCE by the end of the summer at 2.5% or higher. I think that potentially sets the stage for the Fed to go into the Jackson Hole meeting in late August, and then you've got a come to Jesus moment. Is the Fed going to acknowledge that maybe this inflation with labor costs and the spike in commodity prices, et cetera, is more sustainable, or is he going to be sticking to the script that this is transitory, it's going to roll over and die?
You know, Aaron, it's hard to think that they'll change the script. They are acknowledging that there's inflation out there. They're working overtime to brace us for the numbers that Phil just articulated, and they're saying it's going to be transitory, which means we all just have to sit by and wait. I think what Wall Street's worried about today is, do we get any hints that they will start to maybe unwind, for instance, the $120 billion? And, obviously the other question is, when will Wall Street accept the fact that, yes, the Fed will eventually have to hike rates anyway?
Yeah, I agree, Charles. Right now, the question isn't whether they're going to change it. It's whether they're going to talk about it. And we've had taper tantrums where just admitting that they're even discussing it sends the markets into turmoil. So I think it's really going to be about the press conference and whether he says, like he did in the last press conference, of saying, nope, we're not even discussing it, or whether he says, yes, we're actually discussing it. And that's what could send the markets into, a little more of a panic. So I think it's just even talking about it is worry about it.
Let's call it a tizzy, right? A short panic, maybe. Yeah. All right, let's shift, guys, to guys and gals, to earnings. There's a few angles out there. First, it's been obviously an amazing earnings season. Revenue growth up 10.4%. Coming into the year, we were looking for like 6%, so far better than anticipated. Obviously, earnings have been phenomenal. The consensus for earnings was like 16%. We're almost at 34%. And I like what I'm seeing, Aaron. I'll go back to you. On the revenue side, we always talk about the bottom line, but there was a long time when this market was getting by without top-line growth. Now we're even getting that. What are your thoughts?
Yeah, I think, the revenue growth is good. I think the big concern is, though, it gets a little complicated because we can't really look at 2020 numbers. We need to actually go back and look at growth from 2019. And so we're starting to see some break-evens or getting similar to numbers to 2019. In the first quarter, it looks like we'll be about the same level and slightly higher profits. And so really seeing growth over 2019 and not just 20 is important to investors and where we'll really feel more secure about the economy growing.
Hey, I want you all to help us out. The audience is, listen, everyone does this, even pros. You pull your hair out. It's a nuanced question, but everyone wants to understand. Why do some stocks go straight to the moon when they report their earnings and some go straight down? They completely crater. And it seems like they had the same results. Case in point, of course, Google versus Microsoft. Phil, explain this for the audience.
Well, I think investors, the analysts, are getting into the weeds on a particular earnings report. The growth in revenues, the growth in earnings, what are the profit margins? What were the expectations? What's the guidance? How is company A doing versus company B in the same sector? So when the analyst is taking that deep dive and he or she understands the numbers, then those subtle nuances are resulting in the stock going up or down.
It happens so quick, though. It's knee-jerk. I'm sitting here, I'm going through. This is my sheet from last night on earnings. Okay, it looks like hieroglyphics. In about 1,000 years from now, they'll think I was an Egyptian. But the point is, they go straight up or straight down, and it drives people crazy. Speaking of driving people crazy, let's talk about the broad market, because it does feel like it's been stalling. You can see with this, we've been in almost the same trading pattern for about a month. Maybe it needs a pullback. Maybe it needs to digest some gains. Maybe we need to shake out some weaker hands before we can make a substantial move higher. Kathryn, is that your thought process here? And if so, how does an investor ride out such a scenario? Do you hold? Do you sell? Do you try to buy the dip?
Well, the price to earnings multiple is critical here. As you said, Charles, the numerator has been so astronomical that it's so encouraging and validating when you get the denominator being earnings, looking like it's corroborating the prices. So in this case, we're seeing effectively that. Second quarter is going to be equally, if not more stellarly spectacular than first quarter, just because those base effects are so detrimental from last year and so favorable. So I think going forward, what the market's going to be looking for is how sustainable is this reopening trade. We should expect banks, we should expect all things recreational, concert halls, consumer discretionary to continue to perform very, very well in 2020 this year. My question is next year, and we have to remember, Charles, that the Fed owns about a third of all Treasuries. So if and when, and Aaron touched on this, if and when the Fed starts to even hint that they might pull back as the world's biggest and most important investor in purchasing and monetizing an extraordinarily exponential growth in U.S. deficit spending, then we are going to see a correction that I think would cause the Fed to retrace its steps.
So, Aaron, on the notion that we're due, so many smart people tell me we're due. So, okay, let's accept the notion that maybe we're due for a 10% pullback. Do you ride it out? Do you sell in front of that so that you have dry powder and maybe buy the dip? How do you go about it?
I would say for 95% of all investors, you hold it. Unless there's something about the stock or the index that has fundamentally changed. So the reason you even got in it has completely changed. There's no reason to sell on a dip and try to buy back on the low. People, it's tough. Even as an institutional investor, very few people do this well. And so rather than losing money on the bid-ask spread, and causing yourself capital gains, and just making that profit even smaller, you're way better off just holding it if you still believe in the stock. So I just tell investors, if you still like it, hold it.
All right. Well, you brought up capital gains, and I want to go there. And let me go back to you, Kathryn, and then you, Phil. Yeah. Kathryn, I know you work with a lot of wealthy individual investors from all over the world. So how will these higher capital gains, we're going to hear the pitch tonight from President Biden. He's going to say the rich must pay their fair share. I think it goes all the way down to, we know it will go down to even couples making $1 million, which means individuals making $500,000. The bar gets lower and lower. How is this going to affect these investors that you deal with? And what would it mean overall for the economy and the stock market?
Cap gains going to 42% has massive repercussions. And I think, Charles, that this could be a 1-2 punch in terms of risk appetite for the markets going into next year. So perhaps I take a more cautious approach. I would rather be selling at current all-time highs when put options and the purchase of put options are so inordinately expensive. That should tell us something. But I think that the combination of higher corporate tax rates, higher marginal income tax rates on the highest earners, plus the capital gains, given that what has taken us this far is, money flooding into the equity market. The last thing we need is the Fed that has juiced the markets to stop doing so, and the government to start to castigate flows going into equity markets. They're just not going to continue.
Phil, how would it impact the way you're investing?
I think you run the risk of a significant sell-off in technology stocks, which have done extraordinarily well here. We saw this last September and October. Stock market was down 10%. Technology stocks were down 20% when it looked like there was going to be a blue wave with a significant increase in capital gains taxes. But Charles, this question of fairness is a very interesting red herring. According to the IRS's data, the top 10% of America already pays 71% of the taxes in this country. The bottom half of America only pays 3% of the taxes. So if we're really focused on fairness, we ought to be talking about tax cuts for the very high, not tax increases.
Right.
Phil, that was a remarkable answer. I did not expect that from you, from the ESG crowd. So we're going to put a banner down. Breaking news. Even the ESG crowd says we can go too far with these tax hikes. I think we leave it there. And Aaron, Phil, Kathryn, fantastic stuff on a really important day. We always appreciate being able to lean on your expertise. We'll talk to you all very soon. And